when you pass away and this property is inherited by your dependents, what then happens is the capital gain goes away. Because think about it, if you continue doing these.
Terrence, thank you again. So in this next episode, we are going to actually dive slightly deeper into some of the things that we did touch on in the previous episode. Because in the previous episode, I wanted us to first look at some of the limiting beliefs, the misconceptions, when it comes to taxes and real estate, right? Now, we touched on a few things. Can you tell us, according to the IRS, who is a real estate professional? What is the qualifications? What's the requirements to meet that that title? That way, when they are filing their taxes, they can literally trigger some of these tax write-offs. Can you, based on IRS definition and also your experience, how someone is able to change their status to fit that?
That's a really great question. So for you to fit the criteria to be a real estate professional, the IRS wants you to have at least 50% of your time or the activities, that you at least 50% of your time should be in real estate related activities. Okay. Like it has to be, say if you are a medical doctor, for example, and you're pushing 18, 15 hours, at the hospital for 5-6 days, it's going to be tough even if you own real estate to qualify as a real estate professional, because the amount of time you have to invest in just the other activities that you have that bring you income is just way too much. So we need to be able to show that in at least 50% of your time is being spent on real estate activities. Now, the thing I love about the real estate professional status is the IRS allows you to group different activities into one. And I think that's one thing that sometimes real estate investors may not necessarily know. So maybe in your case, for example, if you are a real estate agent, right, the time you spend doing activities related to that can be grouped together with the time you are spending as a landlord, right?
Right.
And all the activities you are doing, managing. So we group those activities in order for you to meet this threshold, right? And so that usually, because without doing that, what happens is the IRS can come and say, you know what, they will treat your activities as separate, right? Even though you do have time you're spending as a real estate agent, they will treat that separately from the time that you are spending as a real estate investor and a landlord. And so that may cause you not to qualify, to meet. So we always want to group your activities, right? Because we want you to meet that threshold. So any of the activities that you have that you are doing that are related to real estate, we lump them together. And then there's also, I think it's 5, there's an hourly requirement, I guess, annually, that you need to meet in order to show that you are a real estate professional. So if you meet that threshold of your time and the hours, then you activate this real estate professional status. And once you do that, the difference between someone who can qualify as a real estate professional and the other one who doesn't is it just comes down to how do we treat, especially the losses on the income is treated the same. The income is treated the same. It's ordinary income. So it'll be added to your W-2 and all the other
Mm-hmm.
income sources. But the losses, how are we going to treat the losses? So
Okay.
if you're a registered professional, then we're able to offset those losses from your activities, from your other income. Whereas if you're not, you can only carry them forward. You can only carry forward the losses.
So, from what I'm hearing, if somebody, let's say, like as you mentioned, is a medical doctor, owns rental properties, a few of them, but also employs property management companies to help manage those properties.
Mhm.
Are you saying that that person cannot count the time that the property management companies are spending on his or her property, as part of the hours required by the IRS?
That may disqualify you because that's not your
Okay,
hours. The IRS
I see.
wants you to be the one who has, you know,
Okay.
so if you're hiring, it almost works against you in a
Mm-hmm.
sense, because now it's
Yeah.
taken away from you. Think about it, all the legwork the management company is doing, maybe looking for tenants, like
Mm-hmm.
vetting tenants,
Yeah.
address tenant concerns, like
Mm-hmm.
like repairs. All of that time would have accrued to you to
Right.
get you to boost your hours, and now
Okay.
you can't claim that, because now the property management company is running with all of these things. So it kind
Okay.
of limits you in a sense, and it probably would be the thing that makes you ineligible.
Okay.
But if you're managing
Okay.
it yourself, you at least have this outlet to accrue the time, because that's what we need,
Okay.
to accrue the time, and then being able to document, like, okay, these are all the activities I've had to do. Think about, if you have a property that's got issues that need to be addressed,
Mm-hmm.
it's going to be you or nobody else. And so all
Okay.
that time can be claimed against you, the owner, and help you to qualify for the status. And then, and
Mm-hmm.
then you're able to get tax benefits as a result.
Okay.
Yeah.
So we are still staying on the real estate professional
Hmm.
piece of it. So in my case, you know, if I remember correctly, the losses that we needed it to, shift onto our W-2 was a lot. I think was it 50 or 60,000? I remember,
Yeah,
right?
it
Right.
was pretty high. It was pretty high.
It
Yeah.
was pretty high.
Mhm.
And I guess what opened my eye was the fact that, you know, IRS claim, we are making a lot of money. So
Yes.
we were only allowed um to I guess claim, 3,000, about 3,000 or 6,000. I don't remember.
Oh
Uh
no, I think that's
three
different.
thousand.
Yeah,
It,
yeah, that's different. I think that 3,000 is the maximum capital, is the maximum capital loss that you can write off.
right, right,
Right. Yeah. So that
right.
would be something different. It wouldn't be the same as these losses we're talking about. The capital losses would be, in your case, I think it was related to stock
No, no,
trade.
no. So the stock trade was one piece, right?
Yes. Hmm.
Was one piece. With the real estate, because of course it was during COVID. So yes, I also lost a lot
Right.
trading
Right.
options and stuff like
Right.
that,
Right.
right?
Right.
Which was also in the thousands, right?
Yeah.
I won't
Yeah. Yeah.
mention the number, but it was close to how much I also lost on the real estate piece. But I guess because I'm trying to remember, and I'm going to segue into a question right quick. So staying on the losses or the capital losses coming from the real estate, right? If you are a high earning individual,
Hmm.
right? One, I don't know, does it, maybe it changes every year. The cap changes every year, or maybe it might be the same. So I can't remember that year it was about, I think, 120 or 123 or something like that.
I,
That if you make that or more, you cannot claim the losses, right?
what I remember what I think it was in that year you did not qualify to be classified
A
as a
relative,
business professional, right?
right,
So, but your income, I think it was, I think there was a cap on the loss. I think that you could write off.
right. And I believe it was like 3 or 6 thousand. I don't remember, but it
No,
was a
no, I
ridiculous
think
amount.
it was actually higher,
Really? Okay.
but yeah, it was. But I can't remember from the top of my head. But I know exactly
Okay.
it's different from the $3,000 capital loss you're talking about. But
Okay.
again, I think the loss was. I think what helped you was um, the loss was limited. Uh, it should have been either 20 or 25,000. There was a cap, but based on your
Right.
income, yeah, it was.
Right.
I'll need to look it up though. I'll need to look up the
Okay.
but it was but it was a cap that was set only because I think your real estate was activities were treated as passive, and so you couldn't write
Yes.
off everything, and it was capped.
Right.
You got some, it was capped, and then the excess was carried forward.
Carried forward. So I guess that the point I'm trying to make is that let's assume someone maybe in my maybe in the same situation I was 2 or 3 years ago, right? So in this case, I'm trying to kind of relay this information that okay, let's say you have 50,000 losses from your real estate, and how much money, because from my understanding, and please correct me if I'm wrong, because I still think I don't know much about taxes, right? uh let's say for instance, if that person is making has a W2 with 150,000, right? Let's start with that.
Right.
And so in this case, it sounds like even a medical doctor, right? There's no way that person can claim that 50% of their time is going towards real estate. So, which means that they are not going to qualify as real estate a professional.
No,
And so they cannot, you know,
they
claim
can't.
all the losses, right? But their income, high income, is also going to hit them on the on at the back end. So currently, what is the cap, or what income range
I'll
should
need
it
to look that
fit?
up. Not
Would
from
it
the top
fit?
of my
Okay.
head. From the top of my head, I don't know what the exact income range is. But yes, I
Okay.
mean it's set by the IRS. They only maybe move it, just like an inflation adjustment every year.
Okay.
Um, I don't remember from the top of my head, but there is an income threshold. So I think the other thing to mention here is that so even though you have losses from real estate that that are disqualified from offsetting from your W2 income, because the IRS is saying, because by default, real estate, the IRS treat it as passive activity. You know
Right.
what I mean? By
Right.
default. So they're treating it as passive. But if you have other passive income, right? For example, any other passive income you have can offset against these real estate losses. But if
Mm-hmm.
you have no other passive income, then these losses can only be carried forward.
Okay.
They don't
Okay.
give you anything if you are over this income threshold. And we can
Okay.
always, and I can always get back to you with that income threshold, and then maybe in the
Okay.
notes, you can always
Because
add that.
I think it is important because it was a shock for me, right? It's like
Right.
it doesn't make sense, right? So have I been punished for
Yes.
having a high income
Absolutely.
and
That's what it
also,
is.
taking the risk to invest in real estate, right? So it was a blow to me. So I wanted to touch on that. Now, you did mention a few things on the previous episode. and even right now.
Mm-hmm.
So having a real estate, um, we've kind of cleared on the real estate professional piece of it. But I want to understand whether it's even passive income or not. Do you think, in your opinion, do you think it would make sense to have a registered business to run your real estate portfolio? And what will be the tax benefits or even tax disadvantages?
That's a really great question. And I would say, generally, with real estate,
Mm-hmm.
I would always recommend real estate investors to operate this activity under some type of entity structure.
Okay.
I mean, I have seen clients come in. I actually do have a client who has, at least $1 million in real estate, and it's all in his personal name. But
Mm-hmm.
but obviously, I think this really speaks into just from the get-go managing your risk, being
Well,
in a litigious
you,
country. Yes,
you did touch on something, and I want us to clarify it right quick. So you can own real estate in a business, under a business, right?
correct.
Meaning that the deed could be in a business name or personal name, right?
Mhm.
Depending on the property type and that investors' experience and stuff like that, they may not have the opportunity to have it under a business.
Mhm.
So I guess my question is more about the operation of their real estate investment, right? So like in my case, as you know, all my properties are in my name,
Right.
but I have businesses operating my properties, right? So I want us to focus on the operation side of it because um, that is something that happens more often than them even having their business, sorry,
Right.
their properties under the business.
I think. I mean, I would say, um, if I were to choose personally, if I were to
Mm-hmm.
choose, I would prefer to have this. If I have a 10, apartment complex,
Mm-hmm.
I would prefer to have that under an LLC.
Okay.
I love the LLC because it's got so much flexibility,
Mm-hmm.
even from a tax standpoint in how we treat it, and also, and so everything related to that entity from my lease agreements are under the LLC's name. Everything, and
Mm-hmm.
then we just run, and then um, uh, the entire operation of the LLC of that investment property is just under that name. That's not
Mm-hmm.
Patrick, or that's not Terrence.
Right. Okay.
If I think that may be a better,
Okay.
uh, from an operational standpoint, situation to work with. Now, you may have, I guess, a question. Okay, so LLC, or should it be a corporation, or
Yeah.
but still, I would say if you have maybe a different, and this is my personal opinion, if you
Mm-hmm.
have, say, a different real estate activity, like maybe flips, maybe you're doing flips, for
Yeah.
example,
Mm-hmm. Mm-hmm.
um, and maybe you know that you're going to be doing, say, a flip a month or something like
Right.
that, and each flip is going to give you maybe a profit of, say, 40,000. I'm just giving numbers.
Mm-hmm.
That activity itself, maybe it's from a just from a tax standpoint, maybe more efficient if you put it maybe under a corporation,
Mm-hmm.
because say, for example, a C corporation, maybe it caps your taxes there 21% versus anything
Mm-hmm.
else where we're trying to avoid the marginal rates on your personal that
Right.
keep increasing,
Right.
so things like that. I think so maybe that maybe for flips, maybe a better entity structure to operate
Mm-hmm.
under. and then your properties, maybe they're still under an LLC that maybe could be just one person or multi-member, depending on if you have investors and things like that. But that's what I would prefer.
Okay.
And I'm only looking from maybe a tax standpoint and maybe
Right.
just risk management standpoint, but maybe the other situations that could maybe impact
Okay.
investors is to go a different direction.
Yeah, and I think for me personally, one of the other benefit that I've noticed when it comes to managing your real estate investments, right?
Mm-hmm.
Especially the operations under an entity is that it helps you separate all the finances, all the bookkeeping. That
True.
way, you are not missing personal stuff with business stuff. And
So that,
personally, all my tenants that, like you said, with they lease it. The lease has the business, at least one of the businesses' names, right?
exactly. Mm-hmm.
So everything goes through the business. It makes it easier for my bookkeeping,
True.
standpoint. And at the end of the year or during tax season, as you know, our routine
It's
just be
always
I
business
have
accounts.
everything. Yeah, I have everything ready for you because I don't have to go back and figure out, what I use my personal credit card
Absolutely.
to pay for, or whether a tenant sent me a cash app
Right.
uh, or a Zelle to my personal account, right? So
Right.
personally, I think that is one of the benefits, and also, on the long term, and this is something that another investor taught me. It's like when you have a registered business, you want to have these activities because in the near future, it makes it easier for you to scale because the bank can go back and look at all your
Exactly.
activities, right?
Yep.
And
Yep.
you are also building a relationship with the bank. So it gives you the opportunity to actually qualify for a business line of equity. Line of equity, which at least all my businesses I've qualified for them, in the past and stuff like that. So thank you for that. Now let's talk about some of the write-offs or the depreciations, right?
Yes.
You did mention bonus depreciation. So let's look at a scenario like this. Uh, Someone who is flipping, someone who is also doing short-term rental, Airbnb,
Mm-hmm.
someone who is buying and holding, right? Can you tell us some of the bonus, not just bonus depreciations, some of the depreciations, and and I also have one more question, but about
Okay.
that to follow up. But I want us to focus on this for now.
Or the bonus. So the bonus just so the bonus depreciation is really lucrative for in real estate, and it came through the Tax Cuts and Jobs Act that former President Trump signed into law. I think it was in
Hmm.
2017. And
Okay.
at the time, what the Tax Cuts and Jobs Act says about bonus depreciation is between tax years 2018 through 22, bonus depreciation was 100%.
Okay.
It was 100%, and it would qualify. It would be applicable to assets that had a useful life of 20 years or less.
Okay.
And then for tax years 2022 through 2026, the bonus depreciation would be cut 20% every year. So 2023
Okay.
it was now 80%.
Okay.
2024 it's 60%.
Okay.
2025 40%. 2026 20%. And
Okay.
if nothing is done with extending the Tax Cuts and Jobs Act, then 2027 bonus depreciation will be zero. There won't be anything anymore,
Okay.
right?
Okay.
So now the other piece with bonus depreciation is So when you buy a rental property, for example, the useful life, the IRS says if it's residential rental property, it's 27 and a half years. It's already
Right.
it's already set, it's fixed.
Right.
If it's like a commercial building, maybe that you're using as an office building, if it's a business owner, it's actually 39 years. It's a long time. So nobody wants to wait 27 years or 39 years to recoup the cost of the asset that they purchased.
Right.
So that's why bonus depreciation is so attractive. And the way you take advantage of it for most real estate people in real estate is you would want to do a cost segregation study,
Yes.
because what that cost segregation study does is you have a company that has engineers that come in and kind of what we're trying to break down the cost of this building into these different components and identify what we can assign as assets with a useful life of under 20 years, because those asset types will qualify for the bonus. So that's what the cost segregation is really doing. So say, for example, if you buy, say, a property for $1 million, right? The first thing is we'll take out the cost of the land, because the IRS say land is not depreciated. So on average, we could just say 20%. So if so we take out 20% from the $1 million. So now you have 800,000 that's assigned to the building. So the cost segregation study has engineers coming in to evaluate what makes up this 800,000.
Okay.
And they break it down. And then the asset types that qualify to have a useful life under 20 years, if it was between 2018 and 2022, they automatically assign 100% bonus depreciation on them. So what that means is on your tax return, when you are claiming the depreciation deduction, it's literally 100% of the cost of all those components.
So which means that, let's say, for instance, if I'm bringing home my W-2, let's say if it's 150,000, right? And the cost segregation, we end up probably having 200,000, right? Yeah. So that first year, going back to you said 20, is it
2018,
2018, right? So we are in what do we call it? 2024. So
it's 60%.
It's 60% now. So let's say 60% of the 200,000, we are looking at what?
Still 120 or
yeah. Hold on.
120.
Yeah, 120, right? So right there, we could write off 120,000 from our W-2, which will be left with 30,000.
And think about it. This is just bonus. So you have all the other expenses related to.
Right. So just even that alone, we are going to be we are going to actually fall in a totally different tax bracket.
Completely. You may not even have taxes. You may not even owe federal income tax in that year, because that bonus depreciation write-off, sometimes it's usually six figures. When I see it, it's so big, it offsets all your other income. Or if it doesn't offset all of it, it really takes you down into a lower tax bracket. I'm talking about maybe 10%, maybe 15%, 12%, maybe 22% at the most. So you're really paying 12%, you know what I mean, on your entire tax return, because you've offset a huge chunk just with the bonus. So that's where the power of bonus depreciation comes in.
Okay.
Because it really, really offsets a lot of what. And then if you may still have depreciation still accruing in future years. So it's not like, you know what I mean? You still, you haven't offset everything. You may still have depreciation accruing in future years. And so you will still have that non-cash write-off against your rental income that you will take advantage of in future years to come. So that's really where bonus depreciation really becomes powerful and really attractive in real estate.
That makes sense. So let's talk about capital gain and 1031 exchange, right? So I do understand that. Let's say, for instance, and I'm going to use myself as an example,
Right.
which one of my properties, when we purchased it, we lived there for a certain number of years, and then we bought another property, and so the old one we rented it out,
Right.
right? Over the years, of course, we pay down on the mortgage, and also the value of the home
Went up.
appreciated,
Right.
right? Then, when it was time for us to sell, yes, there was a capital gain. Now, according to the number of years that we lived there, and also the number of years that we rented it for, in our case, we didn't have to pay for capital gain, right?
True.
Um, Now, I also know that in situations where you have to pay capital gain, one of the things to help you, I guess, push the taxes into the future is to use 1031. So, can you touch on capital gains when you can avoid capital gains? And if you cannot avoid capital gains, how does a 1031 exchange fits into this whole tax equation?
Right. So when you talk about capital gain, anytime you sell a rental property that you have owned, whether you've owned it for a day or a year or 10 years, that sale triggers capital gain
Okay.
because the IRS is saying, hey, we would like you to compare what your cost basis from a tax standpoint with this property is and what you were able to collect in proceeds. Let's
Okay.
compare those. If the proceeds are higher than the cost that you acquired this property for, and maybe less depreciation if you were depreciating it, then they are saying, hey, you owe us. You owe us something
Yeah.
here. Now, capital gains is taxed either 0%, 15%, or 20%.
Okay.
If it's a long-term capital gain, meaning you've held this asset for at least a year.
Okay.
There are clients I have come across where they have a capital gain, but they're in the 0% bracket because the income threshold that they are in qualifies for 0%. So they end up not paying anything, which is awesome. But also,
Wait.
yes.
So you mean the income from the sale or the W-2?
Yeah, the other income. The other income is what would qualify you, depending on what your other income sources are. You may qualify for a 0% capital gain tax rate.
So which means that your other income, and I'm still stressing on W-2 because there's a lot of people who still have W-2, right? So that, and we are still stressing on high income individuals.
Right.
So your high income always puts you, I guess it follows you almost everywhere you go. And that is
Yes,
why it is very important to
it
think
does.
of do tax planning. I
Absolutely.
really want to stress on that because
Absolutely.
what you just said, I wasn't even aware of that,
Oh
right?
yeah. Oh
So
yeah. Yeah.
now
It
now
is, but
it
but yeah, but high income, I think automatically would either push you into 15 or 20% for the most
okay.
part. Yeah.
Okay.
So but anyway, it's still okay because even though you are in this 15 or 20% bracket, if you haven't done any tax planning proactively, then you're gonna have a tax bill to pay.
Right. Right.
Now, that's where 1031 exchange is coming. Actually, if I'm not mistaken, 1031 is actually a section in the IRS code. It's actually that's
Okay.
the
Okay.
1031 exchange comes from, and it talks about like kind exchanges. So and I wanted to just mention that in there that the 1031 exchange applies if you sell and then within I think 6 months, there's a time frame. I think it's 6 months. Use the proceeds of the sale of this property to buy another like kind property.
Okay.
That process is what qualifies the transaction as a 1031 exchange. And what that does, what the IRS says is, by doing a 1031 exchange, you defer the capital gains tax that would have been due if you didn't buy this other property. The capital gains tax you should have paid us, you get to defer because it's been rolled into this new property that you have purchased.
Okay.
So the beauty of that is, you know, I know your platform talks about wealth preservation, right?
Right.
So your portfolio is growing because most of the times when people do 1031 exchanges, they're buying a property of a higher value, maybe bigger property. So you're going into a bigger property, you're owning, your portfolio is increasing. And at the same time, you have utilized the tax provision that's available to, you've activated it to defer capital gains. So your cash flow is not impacted as much because you don't have this huge capital outlay in taxes to pay. Right. And may I also say, if you think about it, the moment you start doing 1031 exchanges, I would say if you are in real estate, if you can continue rolling over this capital gain or doing 1031 exchanges over the entire stretch of your lifetime, what happens is when you pass away and this property is inherited by your dependents, what then happens is the capital gain goes away. Because think about it, if you continue doing these 1031 exchanges over a stretch of 20, 30 years, the gain is going to continue getting bigger and bigger and bigger. And the tax bill, the capital gains tax that's due, if you end up selling and then not buying another property to do another 1031 exchange, if you break the cycle of the 1031 exchanges, you're going to owe a lot of taxes.
Right.
So now the strategy is, once you start on the 1031s, if you can, you got to keep doing them all the way till death, because what then happens is your passing away activates for your dependents what the IRS calls a step up in basis. So step up in basis means your dependents are inheriting the property, but for tax purposes, the IRS will give them the cost to be the same as what the market value of this property is.
I see.
At the time of your death. So what then happens is, if your dependents turn around and sell this property the day after you pass away, their capital gain is zero because the cost is almost the same as what the selling price is.
I see.
So just by doing that, guess what? You have completely avoided capital gains on this.
So I really didn't know this, which is good. And now I even have more questions. So we might have to set another time.
Right.
To probably dive
but
into
I wanted to make sure I explain this all the way, because then that's how you see where real estate, and just a side note, I've heard about this, that real estate has really powerful lobbying in DC, because all the provisions that affect real estate, they're really powerful. Like if you are able to activate them, think about it. Anything else, if your dependents inherit, say for example, a 401k or an IRA, there's almost going to be some tax obligations that they'll have to pay, even though they inherit. Now with rental property, and think about how big your portfolio may grow over time, and all of that. If you keep doing these 1031 exchanges, maybe that entire gain, capital gains tax goes away. So that is an amazing benefit. If you can take advantage of it, absolutely it's worth it.
Okay. Now I do have a lot of questions, but there is one. So I have a question about how do we call it? Putting your real estate in a trust and how that is going to affect the taxes piece. And I think maybe we can set up another time to touch more on that. But one question I want to ask, it goes back to what we've talked about, cost segregation, right? So cost segregation 1031. So let's say, for instance, I own like my four unit
Mm-hmm.
building that I have, right? Let's say, for instance, if I decide not to sell it, right, and I do cost segregation on it to get a benefit of the bonus depreciation, right?
Right.
But I want to do a 1031 exchange, right? How is that going to affect the first cost segregation that I did? I guess no, the first bonus depreciation that I got from my cost segregation. And also, when I'm doing the 1031,
Mm-hmm.
I know I'm selling the first property to buy a light or something that is more expensive or bigger.
Mm-hmm.
Am I supposed to use all the proceeds from that purchase in purchasing the first one? So I guess
There's two
there's two
parts here.
questions in there. Yeah.
Yes. So so
Can you
so
touch on that for me?
absolutely. So if you do bonus depreciation on your 4 units,
Mm-hmm.
right? Say you had 100%. Let's say you did this in 2021. You got the
Right.
100% bonus depreciation. Think about it. If your 4 unit costs $1 million, we
Mm-hmm.
remove the land, say
Right.
20%, 800,000. If you had bonus depreciation, usually bonus depreciation, say it was, and I'm just throwing around numbers, say it was 500,000 bonus
Mm-hmm.
depreciation that you were able to take advantage of.
Mm-hmm.
So what happens now is the tax cost or tax basis of that property from an IRS standpoint is the $1 million less the depreciation,
Mm-hmm.
the 500,000 that you took. So from an
Mm-hmm.
IRS standpoint, the tax cost of your property is 500,000 now.
Right.
If you turn around and you sell this property for $1.5 million,
Okay.
the only impact is your capital gain is now bigger. Your capital gain
Yes.
becomes bigger because IRS is now saying, okay, you sold for 1.5, but your
Right.
tax cost is now 500,000. So this
Right.
$1 million is what's up available for us as a
To
capital
tax you on.
gain. So now you do
Oh,
the
okay.
1031 exchange, and yes, going to your second question, you have to use the entire proceeds of
Okay.
this sale
Okay.
to purchase the new one. Because if you don't do that, there's going to be an apportionment of,
Mm.
okay, of this 1 million capital gain. Part
Mm-hmm.
of it is now taxable. The capital gain you absolutely now need
Right.
to earn because
Right.
you've actually cashed out. But if you roll it over into the new property, which is
Mm-hmm.
why most real estate investors end up buying a bigger property, right? From
Right.
what they,
Right.
because the selling price has gone up, you want to buy a
Yes.
bigger one. If you
Yes.
do that, you've rolled over this $1 million.
Okay.
And think about it. Tax on that $1 million capital gains, it's a couple $100,000 right there. So
Yeah.
you've actually avoided that tax hit and
Mm-hmm.
pushed it down the road. And you can keep pushing it like we just talked about all the
Right.
way until you die.
Right. And even do cost segregation on the bigger property to
It's a new property.
offset. Yeah.
Right. It's a new property
Offset
now.
that.
It
Okay.
qualifies, for its own bonus depreciation because
Right.
it's a different investment by itself. And so you keep rolling forward
Okay.
like that all the way. It's so powerful. Circling back to this wealth preservation,
Yeah.
idea, it's worth looking into. Because it's so powerful, and if it's done and done right,
Mm-hmm.
all the way to your own, heirs or
Yeah.
beneficiaries, they
Right.
will benefit from that down the road, and won't even have to pay any tax to get that benefit.
Thank you so much, Terrence. I learn something new whenever we talk about taxes, and of course I did today too. And we definitely have to do another episode
I
to
agree.
probably narrow down on some of these topics that we couldn't touch on, because I know with this 2 episodes we've been focusing on investors, right? But
Right.
also would like to talk about, we can talk more about individuals that are not so necessarily investors, but they own their own residents, the tax
True.
benefits and all that stuff.
True.
I know, we are up. We don't have much time today, but I will reach out so that we set another time just
Absolutely.
to talk to those individuals so that they will see the tax benefits, especially high earning individuals that you know.
Absolutely. And I think before I know we're getting to the end, I just wanted to preface something too for
Sure.
your audience. Just obviously, this is we're in 2024. 2025 is going to be a big tax year from a
Yes.
policy or legislation standpoint, and so it's just important that we keep our the awareness on what almost like like a scenario analysis of okay, so we have maybe the Tax Cuts and Jobs Act right now that has these provisions that maybe real estate investors are benefiting from. Scenario A, what will happen if this piece of legislation expires
Right.
and it's not extended, right?
Mm-hmm.
What is going to happen to your investments in real estate or your portfolio? What
Yep.
is the tax climate going to look like?
Mm-hmm.
But we know if nothing is extended, if this legislation expires and there's no agreement in DC, we are reverting back to the tax system we had in 2017.
Yeah. Yeah.
So what's that going to look like? So it's just a gentle nudge to be proactive, especially with next year, and see what is the direction the tax legislation is going to go and how it's going
Okay.
to impact you. Maybe we'll have a completely new, different policy that we don't even know, but it just speaks into this tax planning idea. We just have to keep looking ahead, being proactive, so we put ourselves in a situation where we control the tax burden that will come our way, and versus having it hit us by surprise because we were not aware or not attentive enough. So if it
Yep.
means
Yep.
reaching out and trying to consult a tax advisor, do that, because you may be coming out ahead on the other side because you've positioned yourself
Yeah.
differently to take advantage of whatever. So it's just the climate we're in. Obviously, it's going to change in the next 12 months from a tax standpoint, and we all just need to be attentive.
Thank you so much. And you just gave me another topic for a future episode. So,
Right.
Terrence, for my audience, if they want to reach out to you to either do business or consult with you, how would they be able to get in touch with you?
I would say I'm available on LinkedIn with my name,
Okay.
Terrence Maniki. We can always connect there. Our website is blueoceantax.cpa, and I think there's contact information there to call or email our office. And we are always looking to engage with business owners, high earning taxpayers, or high net worth individuals, because there's almost always so many different looks to consider to see how they can optimize their tax outcomes. So
Okay.
LinkedIn, our website, we're always looking to connect and connect with taxpayers.
Thank you so much, Terrence. I really appreciate your time, your knowledge, your expertise. It's always a pleasure. Thank you so
Appreciate
much.
appreciate it, Patrick. Thanks for inviting me over to your platform.
You're welcome.